So today I'm working more on my stock market model. This is the layout of the model. There's going to be a portfolio manager which manages the sectors. Each sector is going to have a sector manager which chooses to how to weight the different buys and sells differently. And then there's also a return predictor, which I'm training on all stocks. Uh, Oh, it's all stocks, but we have to define stocks in a universe because if we use everything, we're going to get not a good model. So we want to exclude random noise, which means excluding things like penny stocks and stocks which don't have any trend. We want stocks which are, mean reverting or trending in a direction. And we want to predict returns on that. That's what I'm working on right now is the return model. Um, and so to do this, I need to focus on different strategies of picking a universe. So if I update the universe at the first of each month since 2012, and then pick the top 1,000 by the previous month's, oh, not top 1,000 volatility volume. So if I get average volume over the last month, pick the top 1,000. This is the result. So 49.41%. It's less than a coin flip. When I get that data and then train the model on it, when I test the model, I'm getting 49.4% accuracy in the direction. And so that is not really helpful. This one, if I train it on, if I add, not only do we need a volatility filter, but we need a Hurst exponent, it performs better, slightly above 50%, but it's still not great. So, what's the takeaway from that? So one of two things. Either maybe this is useful if I weight the play on how big the returns are, slightly over 50%, but I want to get something better, 51, 52, something like that. And what else? I think maybe I could train this on, oh, this is the wrong folder. Let me open up the stock market folder. Yeah, so this is the third version of the LGBM. And so what's V2 do? Oh, V1 is just training on a single stock just to get a feel for the LGBM. V2 is training on that first universe here, which doesn't perform well. And V3 is training on this universe. And so one thing is I'm getting a lot of files. I need to trim down how many files I have. And I also need to work on picking the stocks for the universe to get a solid strategy. So, let's think. Oh, and there's another thing, which doesn't really make sense. So when I look at this model, I guess I could just do V2. Python 3, LGBM. Sure. V2.py. Let's look at the output. So that's how it performs. There's this weird thing going on, which I don't really understand. And if we take, if we offset the green curve by minus 0.04, we're not going to do very well. So it's not clear that this is beating the market even. So, and then V3 gives me this plot. And so, uh, so the concern here is it looks like, okay, the strategy does outperform the market, but why are we picking stocks that are going down? So over 2024 and 2025, but we've been in a bull market, and so This is concerning because, well, we could just plot the SPY also. So let's go to V3, plot show. So let's do here, get SPY data. And then we can say, let's get it from Dolt Reader. Okay, so data dr equals data reader. At the top, let's import that file. So from Dolt Reader, import data reader. And to get SPY data, so we want to get SPY from 2024 101 to 2026 1231. And then SPY returns is equal to dr.stock data of open, high, low, close volume dot log return, say of log return dot CumSum. And then let's plot the SPY returns. SPY dr dot stock data of open, high, low, close volume dot date is X, and then Y is going to be SPY returns. Label is SPY. So color equals red. Magenta. Get phased up. Oh, thanks. Hi, buddy. So there's my problem. Okay. So this outperforms my stock universe, but the stock universe is no good. So why is that? So let's go put this up here. Let's go to Google AI Studio. Oh, I forgot I have to put a comment in the chat. Thanks for watching. I work on this every day. Subscribe if you'd like to follow along! Exclamation. Okay, so I have this script to get data volume Hearst.py. Gets names, gets data for stocks in my universe. I want high liquidity stocks as well as those which are not random. To do this, I use a liquidity, I filter for liquidity and Hearst exponent far from 0.5. The returns model outperforms the average for my universe, but I train and test the model in LGBM v3.py. Outperforms the average for my universe, but the universe appears to go down in time. Verify the scripts perform as intended, and give a suggestion for picking my universe. Yeah. Run. Oh. No. Stop. Okay, and then let's put the files in. Get data, volume, Hearst. Yeah. And then LGBM v3. Upload. Hey, Global. Oh. You don't. Oh, man. Thank you. That would have ruined the whole stream. Man. That is super helpful, Global. Mac OS screen capture. Okay. Do the other display. Okay, now this is live, right? Upload. Good. Man, thank you, Global. That was helpful. I wish somebody else had commented that earlier. Pinned comment. I guess I shouldn't pin that. I'll pin your hey yeah comment. That was extremely helpful. Okay. So oh, I want to add the plot too. Here's what the plot looks like. So see this global, this is, I've trained a model. It outperforms the stocks in my universe, but it way underperforms the S&P. And my universe underperforms the S&P. And so I need to pick a better universe. Okay, that's going to take a long time. So let's go look up here. SPY selection criteria. Okay, SPX. Okay. Oh, selected by a committee. Oh, so the Russell 3000 is just 3,000 biggest market cap stocks. Minimum $1 price, 5% float. Okay, good. Here's the verification. Both scripts perform the logic as intended. Why does the universe go down? The gray line in your plot represents average performance of the stocks you selected. The fact that it crashes while SPY goes up indicates that you have selected a junk universe. Here's why your specific filters create this bias. The efficiency penalty, efficient market hypothesis, suggests that highly liquid, stable, and profitable stocks follow a random walk closely. The Hurst exponent is usually very close to 0.5. Okay, so that's the answer. Oh, many predictable trends in the market are distressed companies trending down to zero. Stocks with low Hurst are mean reverting. In practice, very low Hurst scores are often found in high volatility. CHOP. You built a universe of volatile, distressed, or speculative assets. Tighten liquidity and use Hurst as a feature. Don't use Hurst to filter the universe, use it to feed to the model. Then we need uptrends, suggested code change. Yeah, you saved the stream. Global. Our hero. Our stream hero. Okay, so we want to feed Hurst as a filter. So get data from stock finder. Oh. Get data volume Hurst. So let's go through it. So really it should start 2011 February. Because I did include start the 1st of 2012, but that was because I was getting the previous year. So calculate Hurst single ticker prices. Okay, never mind. I am getting Hearst for the whole year, so let's start January 2012. So we don't want to do the Hearst mask. All data.loc. So where's Hearst calculated? So Hearst mask is doing all data. So it's getting where date is greater than Hearst start and date is less than target start date. df Hearst is all data.loc. Okay, so this is getting the Hearst data. Hearst scores for ticker hval. For month, right? Yeah, for month and month. So this will just do it the first of the month. You don't use the chart opening and close. Wait, what do you mean? Yeah, this is basically chart data. What's it called? There's open, high, low, close, volume. So that's all data that you have in any candle chart. You're talking about the Japanese candle charts, right? Come on, thing. Where's the chart? Oh, chart. Damn, this sucks. I used to use Yahoo Finance all the time, but now I don't like it. But I know they have the candle charts. Come on, hurry up. I don't know why this is going so slow. This is, yeah, whatever. Come on. Not this chart you're talking about. Well, I don't know. This is so damn slow. I don't think I can even get a candle chart. Oh, mountain. Whatever. Oh, thanks. I need to reposition. There I am. Remind me later. This is what you're talking about, right? Because this data is basically the data I have. We're just not looking at a chart. And then the graph, it doesn't matter for the chart because it's just looking at returns, not price data. When I'm looking at the results. Okay, so write me a new script for get, we'll just say rewrite get data volume Hearst to the top 1,000 tickers. Oh, okay, never mind. I already have. If I'm only filtering for volatility, I already have that. Get data from stock finder. So that's here. All training data .feather. So let's see. Get out of the plots. Python 3, import pandas as PD. Alright, then we'll say df equals PD dot read CSV. No, read feather. And we want to look at this guy. Sample is equal to df.head 500 sample.toCSV sample.csv. Here's a sample of the of the universe I selected using only the liquidity filter. Add first exponent as a column in the data set inside of algorithmic v2.py. So then once the Hurst exponent's in there, we can say then update algorithmic v2.py to use Hurst exponent as a feature. How much time over which should I calculate Hurst exponent? Okay, that's fine. Sample and then algorithmic v2. Okay. Okay, I'm gonna run to the bathroom real quick while this runs. Okay, so let's send that in. Let's make a new script. v4. And we're gonna say So 125, 2026. The rolling Hurst exponent's going to take a long time. I guess that computation's just taking a really long time. If this continues, what do we want then? We want to update, get data from stock finder. Change get data from stock finder.py so that it uses mostly currently when I run that, it takes a lot of RAM and not much CPU, so that it uses more CPU and less RAM. Get the optimal solution. Also adjust this script so that it adds the Hurst exponent going back 1 year. As a column to the final data frame, which is saved. Then let's give it the file, get data from stock finder, and run, because this guy's still going. So this is going to take a while. Even once I get a new script, that script will take a while to run. So let's go back to the AI bubble research. So let's go back to what I wrote. Absent in-depth research, it's my intuition that we're in an AI bubble because of the large amounts of money being thrown around at odd, seemingly false promises. Yes, that's my intuition. Despite this, I disagree with analyses which say this is a bubble because they say things like AI has no use other than for students and nobody pays for AI. That seems to ignore all the good attributes, and that this is a exponentially increasing. So again, 49% isn't much better, but that's calculating Hurst exponents differently. Okay, so get data from stock finder. So it didn't improve anything because it's the least important feature. That's not surprising. Okay, let's put this version here. So that was not the last year of first exponent. Okay, so let's run this again. Python 3 get data from stock finder. Okay, so back to the AI stuff. So let's say the core thesis is, or the core thing I'm exploring here is I think it's overvalued, but I disagree with lots of the overvalued assessments. And so, key factors in .com bubble. So let's remember, it's the Asian financial crisis. So key factors of .com bubble. So first, Asian financial crash of 97, 98. We also had cutting interest rates. We'll just say Fed cut interest rates. When the market was already hot. Heavy CapEx expenditure in infrastructure years before it became useful. Okay, so is there anything else I'm missing here? Oh, right. Paradigm shift in market investment. Tech companies. Bad balance sheets with promising future. Is there anything else? Financial policy, got it. Get big fast business model. How do you assess that? They prioritize market share over profitability. How do you assess that a company's doing that? Startups spent lavishly on marketing. Ooh. Right, so marketing I never trust. Anything else? That sounds like AI. Researchers found that companies could significantly boost their stock price simply by adding .com to their name, even if their core business hadn't changed. Okay, so real quick, let's start another document. On the Bitcoin target for the end of the year. Oh, I think I actually already have a document. Okay, so I have here too a key question. Did FTX crash exacerbate peak to trough ratio in last cycle? So here's the thesis. I expect the peak to trough ratio to appear, no, not exponential decay. What's the curve trend where the curve is asymptotically approaching 0? Not logarithm, not exponential decay. I don't think it's exponential decay. Oh, it is exponential decay. Really? Oh, yeah. Okay, so I expect it to appear as exponential decay. But it appears linear. This is why the trend fits the data poorly. In the plot, we'll call it figure 1. Insert caption. Figure 1, good. In figure 1. Why is this? One reason could be the ratio dropped too low off trend because of the FTX crash. This Bitcoin cycle also, this Bitcoin cycle, which corresponds with crypto cycles, Bitcoin drives the crypto cycles. I'll just say BTC drives crypto cycles. Also was also characterized by the preponderance of NFTs, which appear useless. So question. I guess task is look into FTX crash and NFTs to determine if this artificially crashed the ratio off of the trend. And also, I think the Mt. Go crash was in 2018. Oh, whoa. That was the previous cycle. Oh. 2014. I didn't realize that was so early. So, was there a crash? Is there a parallel to FTX collapse end of 2022 at Bitcoin near Bitcoin minimum in the 2018 crash? So the parallel in 2014 was the Mt. Go collapse. In 2018 was there a parallel? Because if we have the Mt. Go collapse in 2014, another collapse in 2018, another collapse in 2022, then at least we have, it's not like nothing collapsed before. We have this, reliable pattern. Hash war wasn't an exchange collapse. It served the exact is the Black Swan event that broke a month-long support level and drove the final capitulation plunge to the cycle bottom. Oh, volatility. So that's good. Volatility. The hell is a volatility index? Wow, look at how that's changed. So there's a clear trend and volatility is decreasing. Could we get this data? So what do we make of this? This is expected. In the sense that, so it looks like there's a general linear trend downwards, but also it's tightening. So, end of 2022, so volatility rose, volatility was low. Okay, this is everybody's selling because the COVID crash. Volatility spikes. Those are really the two runs. Oh, mid 2021 there is a run. End of 2021. So the volatility dropped, and then it kept dropping. Okay, so here's the volatility at the historic low. The thing is, as institutional adoption goes up, volatility is going to go down, obviously. So, gosh, this is taking forever. Maybe I should just ask it to rewrite the other script. Now rewrite explain to me again your criticism of the volatility filter, of the liquidity filter. This is taking too long. So I want to basically rewrite not this file, rewrite this file, but I need to know, how do I want to change the volatility filter? Reverse quality filter. By combining a loose liquidity threshold with a high Hurst requirement, you systematically excluded the best stocks. Well, I'm just using the top 1000 by volatility, so that seems fine. Okay, that's what this is doing. Top 1000 by volume. Okay. Rewrite get data volume Hurst.py to get the top 1000 liquidity stocks. Add the Hurst exponent over the previous year as a feature to the final data set, and exclude any stocks which are trending down to 0. Is there anything else? No? Okay. Okay, so volatility is an indicator. So let's see what did volatility do in the past. So let's look at the table. So let's make a table. Okay, so what are the columns? We want high. Okay, cycle number. And then we're gonna have the high. What happened at the peak? What happened at the minimum? What happened at the return to the peak? What? Oh. going to call this figure 2. Can't do a caption there. So cycle number, what happened at peak, what happened at trough, what happened at return to all-time high. So cycle 1 peaked in 2015, cycle 2 peaked in, cycle 1 peaked in 2013, cycle 2 peaked in 2017, cycle 3 peaked in 2021, and cycle 4. Alright, so what happened at the peak? Cycle 1 peak, 2013. Peak in volatility in April. We got a peak in volatility in April, drop to local min in September, local peak lower December 19th. Local peak in December 2013. That was at the all-time high. What happened in the trough? So okay, so the trough was January 2015. There was a spike in volatility. Okay, then the return to all-time high, December 2016. All-time min in volatility right before return. Okay, cycle 2 peaked when? December 2017. Spike in volatility. Volatility close to minimum in May. Okay, then what happened at the trough? Okay, let's go back to rewriting this script. Where did that window go? Oh, it's here. Okay, so just call this get data v3.py. Okay, that's running and running. Let's stop that. And instead, let's run Python 3 get data v3. So we're gonna loop through months and years. Let's print month, year, so we know what we're on. We can see how quickly it's going. Save Python 3 get data v3.py. Three, 4, 5. All right, that's going a lot faster. All right, so now what do we want to do? So we're good at that data. Okay, let's go back. So what happened at all of these? So trying to see if we can notice a trend. So what happened at the trough, end of 2018? Min volatility plus local spike. Volatility before trough, spike in volatility at trough. Okay, so back to the 2014 minimum. What happened? 2014 minimum, 2014 Bitcoin minimum. On December 30th. Oh, 20, did I just say 2014 or 2015? Yeah, 2014. So it was December 30th. Local min volatility at trough. Oh. 2015 Bitcoin minimum. So it's probably early 2015. January 14th, so same thing. There's a drop. Drop right before trough. Spike. What is this guy? Oh, so this guy's almost done. Now, if we go to the script, get data v3, LGBM v4. We don't want v4, we want v3. Just tell it to update the script. And get we still want daily returns so we don't trim out all of the data. Oops. LGBM v3. Okay, let's put it in. And run it. What? Why is it unstable? So same thing. Kind of looks like the same thing as before. So let's go back to the AI bubble stuff. Key factors of .com bubble, predictions, oh, did I do that twice? Okay, so these are the real things with the .com bubble. Now, (3008), 2008 crash. The intraday paradox. Oh, the vast majority of gains occur overnight. I guess that would be okay. So we sell it open and buy it open. Daily log return. Close divided by the previous close. That is my target. Oh no. So the log return should be the target. But that's what I was doing before. Log return shouldn't be a feature. Log return is close divided by the previous close. So it shouldn't be a feature. Okay, so how does this perform? Probably we want to change the plotting. Oh, that'll still be right. Whoa, okay. That seems like it's too good. Right. So morning gap shouldn't be a feature. That's kind of gross, sorry. Okay, that looks a lot more reasonable. So I guess, so we're saying the top 1,000 liquidity stocks are underperforming SPY, which is fine because SPY, as we just saw, the big market caps are dominating. 51% seems like it's usable for the model. And so my suspicion is that if we add an allocator to balance it on how high the predicted returns are, we should be good. My intuition tells me that this is now a good model. Look at the code to make sure I'm not getting any data leakage and that the test isn't cheating in any way. My hunch is that this model will outperform SPY once I add in a layer which weights the picks. I want to upload the model file. Let's put this in the PowerPoint. Got good returns model features. Okay. Now if we exit out, here are the features. That looks like shit. Whatever. It implies I buy the stock at the close. You're assuming that you buy at the close of the previous day because here's a mathematical breakdown. In your script, you define target as close divided by previous close. This calculates the return from yesterday's close to today's close. So do I want to do open the timeline of trade? Okay, let's go to GitHub and add everything. Let's ignore. Whoa. That's a lot of stuff. Updated data fetching for universe. updated models. Push. Okay, so that's it for today. Thanks for watching. I work on this every day, so tune in next time. What else? That's it. Thanks for watching. Adios.